1694. England is at war with France. And it is losing. The English fleet has been destroyed at the Battle of Beachy Head. The army needs men, weapons, ships. But King William III has no money. He has raised taxes. He has borrowed from everyone he could. And it is not enough. Then a Scottish merchant named William Paterson proposes a deal. Create a bank, Paterson says. A new bank. Let citizens invest in it £1,200,000. That money goes to the government to finance the war. In return, the government pays the bank 8% annual interest. And the bank gets permission to issue banknotes. The government gets money for the war. The investors get a return guaranteed by the state. And the bank gets the privilege of issuing banknotes, that is, of creating money. On the 27th of July, 1694, Queen Mary signed the Royal Charter. The Bank of England was born. And with it, an idea that would change the world, the central bank. In previous episodes we have seen how banking evolved from temples to goldsmiths, and how commercial banks discovered they could create money through loans. But a system where each bank creates money on its own has an obvious problem. Who supervises? Who sets limits? And what happens when a bank runs out of liquidity when it needs money urgently and nobody will lend it? The answer to those questions is the central bank. And its story begins with a war, a desperate king and a merchant with an idea. The Bank of England was not created to be a central bank. It was created to solve a specific problem, financing the 9 Years' War against the France of Louis XIV. The mechanism was ingenious. A group of investors, merchants, nobles, even the king and queen themselves, contributed £1,200,000. That money was lent to the government at 8% annual interest. In return, the investors became shareholders in a new entity, the Governor and Company of the Bank of England. And the crucial part, the bank received the right to issue banknotes. It could print paper that people would accept as money, backed, in theory, by the government's debt. It was an arrangement that benefited both sides. The government got financing. The bank got the monopoly of creating money in the form of banknotes. Sound familiar? It is essentially the same structure that exists today. Governments issue debt. Central banks participate in the markets for that debt. And the currency, the pound, the euro, the dollar, is backed, ultimately, by trust in the state and in the institutions that manage the money. It all started with a war. And with a deal between a king without money and a group of investors who saw an opportunity. The Bank of England of 1694 looked nothing like the one that exists today. It was a private bank. It had shareholders. It sought profits. And it competed with other banks. Its transformation into a true central bank was gradual. It took more than 2 centuries. In the 18th century, the bank acquired increasingly public functions. It became the government's bank. It managed public debt, collected taxes, paid civil servants. Other banks began depositing their reserves at the Bank of England, for safety and convenience. Gradually, it became the banker's banker. In the early 19th century, financial crises forced the bank to intervene repeatedly to rescue banks in trouble. Each crisis made it clearer that someone needed to act as the safety net for the system. And the Bank of England, given its size and its relationship with the government, was the natural candidate. But the great intellectual transformation came from a journalist. Walter Bagehot was the editor of The Economist, the magazine that is still published today. In 1873 he published a book called Lombard Street after the London Street where the banks were concentrated that changed the theory of central banking forever. Bagehot observed the financial crises of the 19th century and formulated a rule that remains the basis of central bank action in emergencies. The rule goes like this: in a liquidity crisis, the central bank should lend freely, at a high interest rate, against good collateral. 3 conditions. 3 principles. Lending freely means the central bank should not ration credit during a crisis. If banks need money, the central bank must provide it in sufficient quantities to stop the panic. At a high interest rate, what Bagehot called a very high rate, serves 2 purposes. First, it discourages banks from borrowing out of unnecessary caution. Second, it protects the central bank's reserves by making emergency credit expensive. Against good collateral means the central bank should not rescue insolvent banks whose assets are worth less than their debts. It should only help banks that are solvent but have a temporary liquidity problem. The distinction is crucial. An illiquid bank has good assets but cannot sell them quickly. An insolvent bank has bad assets. The first deserves help. The second does not. It is a distinction that sounds easy in theory and is extremely difficult in practice. In the middle of a crisis, how do you tell an illiquid bank from an insolvent one? Often, you cannot. And that ambiguity has generated endless debates and controversial bailouts for 150 years. The Bank of England was the first modern central bank, but not the only one. Its model was exported, with variations, to the entire world. The Swedish Riksbank was founded earlier, in 1668, but initially functioned more like a commercial bank. Over time it adopted central bank functions. The Banque de France was created by Napoleon in 1800. The German Reichsbank in 1876. The Bank of Japan in 1882. The Bank of Spain in 1856. All followed, with variations, the British model, an institution that issues currency, acts as the government's banker, supervises the banking system and, in times of crisis, lends as a last resort. But there was a large and powerful country that resisted for more than a century creating a central bank. A country where distrust of centralized power was almost an article of faith. The United States. By the time America decided to create its central bank, it took a devastating financial panic, a multi-millionaire banker who acted as a private central bank, and a secret meeting on an island off the coast of Georgia. Before moving on to the American story, there is an idea we need to fix in place. Because it is perhaps the most important lesson in the entire history of the Bank of England. The independence of the central bank from the government. For centuries, the Bank of England was subject to political pressures. Governments wanted cheap money to finance wars, projects, and electoral promises. And when the government controls the central bank, the temptation to print money to finance public spending is enormous. The problem is that printing money without backing generates inflation. And inflation destroys the value of people's savings. Which is exactly what we saw in Season 2 with the cases of Venezuela, Zimbabwe, and the Weimar Republic. The solution, which gradually prevailed through the 20th century, was the operational independence of the central bank. The government sets the target, normally, low and stable inflation. But the central bank decides how to achieve it, without political interference. The Bank of England gained full operational independence in 1997. Since then, it is the Monetary Policy Committee, not the Prime Minister, that decides interest rates. Does it work? The evidence suggests it does. Countries with independent central banks tend to have lower inflation and more stable economies. But as we saw in Season 2, when that independence is violated, Venezuela, Argentina, Turkey, the consequences can be devastating. Why should we care about the history of a bank founded more than 300 years ago on the other side of the English Channel? Because the Bank of England invented the model that governs your money. The European Central Bank, which manages the euro, follows the same principles: currency issuance, banking supervision, lender of last resort, operational independence. When the ECB decides to raise interest rates, as it did between 2022 and 2023, your mortgage gets more expensive. When it lowers them, it gets cheaper. That decision is made by a committee of people you did not elect, following a logic that traces back to Bagehot and the founding of the Bank of England. It is not a conspiracy. It is an institutional design. A design that says, decisions about money are too important to be left to politicians who need to win elections every 4 years. You may agree with that design or not. But understanding it is fundamental. Because it affects your mortgage, your job, the price of food, and the stability of your savings. Every day. 5 key ideas from this episode. First, the Bank of England was founded in 1694 to finance William III's war against France. A group of investors lent £1,200,000 to the government in return for the ability to issue banknotes. Second, it started as a private bank and took more than 250 years to become the central bank we know today, a public institution that issues currency, supervises banks, and acts as lender of last resort. Third, Walter Bagehot formulated in 1873 the golden rule of central banks: in a crisis, lend freely, at a high rate, against good collateral. Fourth, the Bank of England model was exported to the entire world. The ECB, the Bank of Japan, and most central banks follow similar principles. Fifth, the independence of the central bank from the government is the most important lesson. Countries where the central bank is independent tend to have more stable economies. When that independence is violated, inflation tends to spiral. England created the first modern central bank in the 17th century. But for more than 100 years, the United States refused to have one. They distrusted centralized power. They distrusted bankers. They distrusted any institution that could control the nation's money. Until in 1907, the American financial system collapsed. And a single man, the richest banker in America, had to save the country out of his own pocket. After that, even the most skeptical accepted that something was needed. But they designed it in secret. 6 men in a railway car. A private island off the coast of Georgia. And a plan that would change the world economy. the Fed and the secret meeting on Jekyll Island. That is what comes next.